Welcome to the Deep Dive. Today we are immersing ourselves in the Q3 2025 earnings call for FiscalNote Holdings Inc., ticker symbol NOTE.
And this one was a wild ride.
It really was. The call was on November 6th, right after market close, and the price action was just completely whipsawed. We saw this dramatic sell-off right after the numbers hit.
And then a huge rebound in after hours. I mean, that volatility tells you everything you need to know about where this company is right now.
Exactly. So our mission here is to filter through all that noise, the big GAAP losses, the CEO's whole restructuring story, the guidance, and figure out what actually drove that volatility.
Yeah, what's really going on, this is, a classic story. You've got an infrastructure software company trying this massive, really complex transformation.
Right, shedding old assets, pivoting to AI and RegTech.
Well, the market is just, deeply skeptical they can actually pull it off.
Okay, so let's start with those headline numbers that caused that initial panic, because on the surface, they were undeniably bad.
They were. Looking at the GAAP earnings per share, it was a huge miss. Came in at negative $1.73.
And consensus was what, negative $0.84?
Yeah, so not even close.
Yeah.
And that meant the net loss actually got worse year over year. It climbed to almost $25 million.
Oof. And revenue wasn't much better.
No, that was soft too. It's a $22.4 million, which missed the consensus of around $22.8 million.
But the big number, the one that probably scared people, was the top line being down about 24% year over year.
Which, for any investor looking for growth, that's a flashing red light. A big one.
But context is everything here, right? And this is, I think, why the market started to reverse course after that initial shock.
Exactly. That massive revenue decline was, for the most part, expected.
It's a direct result of their strategy of divesting these non-core, lower-margin businesses to clean things up.
Right, to focus everything on their core PolicyNote platform. That cleanup started back in late 2024 and ran through the middle of this year.
With some pretty big divestitures. ISIL, Oxford Analytica, Dragonfly.
And also Timebase, their Australian legal platform. So yeah, these were big, complex deals that were guaranteed to drop their reported revenue.
But the idea was to also drop complexity and, their cost structure.
Right. So the GAAP net loss balloons to nearly $25 million, which looks scary. So what was the silver lining? What triggered that huge after-hours relief rally?
It had to be the adjusted profitability numbers.
That's it, adjusted EBITDA. It came in positive at $2.2 million.
Which not only beat their own guidance, but it also represented a 10% adjusted EBITDA margin.
And that right there is the proof that the operational discipline is starting to work, even if the GAAP loss looks bad because of, non-cash charges like stock comp and amortization from old deals.
Okay, but let me push back on that a little. A 10% margin. When you're selling off lower margin businesses, shouldn't we expect the remaining core margin to be, a lot higher than just 10%? That feels more like just staying stable than a huge efficiency gain.
That's a very fair question. And you're right, 10% isn't, world-beating in the SaaS universe. But management spun it as a sign of incredible resilience.
And I guess they have a point.
They do. They were quick to point out this was their 9th straight quarter of positive adjusted EBITDA, and the 5th straight with margins at or above that 10% line.
Given all the chaos of the restructuring, just holding that line is a victory in itself.
It is. It shows a real commitment to cost control.
Yeah.
And it really stabilized the story right when investors needed to hear it.
Okay, let's unpack that operational resilience. We need to look at the recurring metrics because that's the real health of the core business, away from all the divestiture noise.
Exactly. When your reported revenue and ARR are dropping on purpose, you have to look deeper. So recorded annual recurring revenue, or ARR, was $84.8 million, down 22% year over year.
But here's the key part.
Here's the key part. On a pro forma basis, so excluding all those businesses they sold, ARR actually showed signs of stabilizing. It ticked up about $0.1 million from Q2.
Which sounds tiny.
It sounds tiny, but for a company whose core has been shrinking, any sequential tick up is a signal. It suggests the PolicyNote transition might finally be working.
Okay, and what about retention? Because stability doesn't matter if you're just bleeding out old customers. So net revenue retention, NRR, can you just quickly remind us what NRR is measuring here?
Sure. NRR is maybe the most critical metric for a subscription business. It tells you if your existing customers are spending more, less, or the same over time. It includes churn, but also upsells.
And if it's over 100%, your existing customers are growing their spend.
Right. And in FiscalNote's case, NRR held steady at 98% year over year.
So they're basically replacing what they lose from churn almost perfectly with upsells.
Precisely. And on that same pro forma basis, NRR was actually up 200 basis points just in the second quarter.
That's a really good sign. It shows that the core customers, the ones using PolicyNote, are sticking around through all this disruption.
It does. And you can see that cost discipline elsewhere too, right? Not just in EBITDA.
Yeah, the adjusted gross margin hit 87%, which is up 100 basis points from last year. And total operating expenses fell 11%. They are definitely running a much leaner ship.
Absolutely. But none of this would matter if they were about to hit a debt wall. And this brings us to what might be the most important piece of the puzzle.
The refinancing.
The refinancing they completed back in August. It was a huge
It
deal.
was massive. It replaced or amended a bunch of convertible notes, refinanced their senior term loan. But what was the single biggest benefit?
Time. The most crucial benefit was extending their runway by about 4 years. It pushed their debt maturities way, way out. That buys them the time they desperately need to actually execute this turnaround.
And there was another sort of technical but really important detail in there too.
Yes, these substantially reduced their PIK interest exposure.
PIK interest, that's payment in kind, right? For anyone who isn't deep in distressed debt, can you explain why cutting that is so important?
Absolutely. PIK interest is a big red flag. It means the company is paying its interest not with cash, but by issuing even more debt or more shares.
So it's a debt spiral.
It can be. So for FiscalNote, cutting that expensive PIK interest means they're stopping that compounding cycle. It shows they're more confident in their ability to generate actual cash flow. This whole refinancing just fundamentally de-risked the balance sheet.
It lets them focus on growth, not just survival.
Exactly. They're not fighting liquidity fires anymore.
Okay, so 4 years of breathing room is transformative. Let's pivot to what they're actually building with that time. This PolicyNote platform and all the AI they're integrating. The CEO, Josh Resnick, kept talking about their roadmap, something like 35 major updates since January.
And the AI focus is really sharp. It's targeted right at that lucrative RegTech market. They're not, chasing some general AI hype. They're using it to solve very specific problems for their clients.
Like who? Who are we talking about here?
Government affairs professionals, legal teams, regulatory compliance officers, people with very specific high-stakes workflows.
So give us an example. How does one of these new AI tools actually work to make the platform stickier?
Okay, take two they highlighted. First, the AI-powered bill comparison tool. Imagine you're a lobbyist. You get updated drafts of legislation constantly.
And you have to figure out what changed.
Right. Manually redlining those documents to find the subtle changes used to take hours. Now, their AI does it instantly. It highlights every little change in language that could have massive financial implications.
That's a huge time saver. It makes the platform indispensable.
Exactly. And the second one is AI-powered legislative drafting. This tool helps clients quickly draft amendments or new proposals using a huge database of historical policy language and legal precedents.
These aren't just parlor tricks.
No, they're serious automation tools for high-value, high-anxiety work.
And this product work seems to be translating into actual commercial wins, especially in their corporate segment.
The data backs that up. Enterprise win rates improved another 400 basis points sequentially in Q3.
And that's on top of a 400 basis point gain in Q2.
Right. So that's an 8 percentage point improvement in their win rate in just 6 months. It really suggests these new PolicyNote features are hitting the mark in competitive situations.
We're also seeing it in the quality of the contracts they're signing, which is, so critical for future visibility.
That's maybe the strongest sign of confidence from their customers. Multi-year contracts now make up about 50% of their new logo ARR.
And that's up from what, 20%?
Yeah, a 2.5 times increase from just 20% in early 2024. Clients are willing to commit capital for long term because they see the value. It's a huge vote of confidence.
But it's not all smooth sailing. FiscalNote isn't immune to the macro environment. Management talked about atypical instability in the U.S. federal sector and the government shutdown.
That public sector softness is a very real headwind for them. Management estimated that the shutdown volatility alone would probably cut 2025 revenue by $2 to $3 million.
Which usually means big federal agencies are delaying contract renewals until their budgets are locked in.
Exactly. So right now, that strength they're seeing in the corporate and enterprise segments is absolutely critical to offset the public sector weakness and just hold the line on their guidance.
Let's talk about that guidance and the big picture for an investor. They narrowed their full year 2025 range. Revenue now $95 to $96 million and adjusted EBITDA at about $10 million.
which is the low end of their prior range. So you can see the hit from that federal instability right there.
And despite all these positive operational signs, the 10% EBITDA margin, the 4-year runway, the ARR stabilization, the stock itself has just been crushed long term.
Oh, it's been brutal. It's trading near $2.35, which is close to its 12-month low of about $1.91.
And to really frame how bad that is over the last year, Note is down over 78%.
While the software sector ETF, IGV, is up almost 29% in that same period, the market is pricing in an immense amount of execution risk here.
It's a huge valuation discount. But the company operates in this really attractive regtech market, which is supposed to grow in the high teens, low 20s for the next decade.
The opportunity is definitely there. The challenge is translation.
Right.
And that's what creates this binary path forward for the stock.
So what are the catalysts we should be watching?
Well, the near-term stuff is pretty straightforward. Can they actually get sustained ARR reacceleration in Q4? Can they finish the PolicyNote migration? And can they keep managing that federal headwind?
And then there's the other big one, the ongoing strategic alternatives review from the board.
Precisely. We've seen analysts slash their price targets after these earnings.
Yeah.
B. Riley cut theirs from $18 all the way down to $7.
But here's the crazy part.
The crazy part is that even after those massive cuts, the aggregated analyst targets still imply multi-100% upside from where the stock is trading today.
Why is that? Why is there still that massive disconnect?
Because the analysts see the inherent value of the core business in a high-growth market, and they believe the refinancing has taken the immediate risk of bankruptcy off the table.
So their thesis is that if the turnaround works, or if they get acquired, today's price is just way too low.
Exactly. The price today reflects a massive discount for the possibility of failure.
Which sets up a truly binary situation. Success means a huge recovery, but failure means more dilution and, maybe even delisting worries.
Okay, time for our final segment. This is where we pitch an outrageous but plausible trade idea for you, the experienced investor. And we have to emphasize, this is not financial advice. It is a thought experiment.
Right. So the stock is super cheap, trading at about 1.5 times enterprise value to sales. But it's also, pretty toxic right now because of that execution risk.
So how do you play that?
Given that deep discount, the sector tailwinds, and the fact that the ingredients for a turnaround are actually there now, the refinancing is done, the platform is stabilizing, you have to structure a trade that captures that huge upside but aggressively hedges the downside.
So how do you hedge that catastrophic failure scenario?
To trade. You initiate a long equity position, but you pair it with a protective put strategy. So you'd buy long puts that expire maybe 6 to 9 months out, with a strike price below where it's trading now, maybe near $1.50 or $1.75.
Exactly. You're basically creating a synthetic long call. You're establishing a known floor for your investment that protects you against the worst case scenarios. A failed turnaround, major dilution, a delisting, all of which are, legitimate risks here.
So you're not just betting on the quarterly numbers, you're betting on a strategic event.
Correct. You're betting on the growth inflection from PolicyNote finally taking hold, or a positive outcome from that strategic review while protecting your capital if the whole thing just stalls out. It's a clean bet on strategic relief.
That's a very clear strategy for a high-risk situation. You get the potential for a huge recovery, but you're protected from the risks that have just crushed this stock for the last year.
A binary trade for a high-stakes binary company.
So to recap our deep dive, FiscalNote's Q3 was operationally solid even with a tough top line. GAAP losses were high, but that adjusted EBITDA margin held firm at 10%.
And crucially, ARR showed that sequential stabilization, helped by strong enterprise win rates, and the refinancing that bought them that 4-year runway.
The market is still very, very skeptical, though, hence the extreme underperformance.
Yeah, the next 6 to 12 months really hinge on whether PolicyNote can drive sustained growth and what happens with that strategic review. It is absolutely a high-risk, high-reward stock.
So we encourage you to watch those key operational metrics in the next call.
Right.
The growth in multi-year contracts, the adoption of these new AI features. Is the stabilization we're seeing now durable enough to overcome the federal headwinds and the capital structure issues?
That is the question you need to keep asking.
And before we go, we have to remind you that the preceding discussion, especially the not financial advice segment, was for entertainment and discussion purposes only.
It should not be taken as specific investment advice. Please, always conduct your own thorough due diligence.
Thank you for joining this deep dive. Good luck out there.